And if you log into Bloomberg, and if you were to type in AAPL US Equity or Apple and search down here for securities, so again, as you do your certification, in the middle screen here, as you type in a Google search across the top, it'll start to narrow down the field of companies. In this case, you'll see Apple, and then the market it trades on US, and then equity is stocks, corp is debt. So that'll get us to Apple. You can see right now they're up about $7.69 a share. And so one of the important screens is that you're going to use a lot this semester is EEO. So once you get to a company, if you type in EEO, it stands for Earnings Estimate Overview. So EEO. And you can see across the top under Function Search, that's the Consensus Overview. And this will be the earnings estimates. We'll minimize this part of the screen. These are the annual earnings estimates going forward. If I switch for period from annual to quarter, then what you'll see here is this kind of reddish column is what they actually reported for the quarter yesterday. So when the press release went out, within minutes, Bloomberg had uploaded the data. So this is what they reported, and this is what the consensus estimates was expected yesterday. So this is what was being compared as they went through the conference call. So as I mentioned on Monday, the analysts were looking for $4.17 EPS. Apple came in at $4.18. The analysts were looking for revenue of $83,972, and Apple came in at $84,310. They were looking for free cash flow of $21.6 billion. Apple came in at $23.3 billion. So here's the thing. Apple clearly disappointed, right? Their sales of iPhones were down over 20%. They're having all sorts of trouble. But here's the thing. The market had already kind of baked that in. And so what's ironic is Apple disappointed less than the disappointment that was expecting, hence stock price up, okay? And I think this is a microcosm of equity analysis and why it's so difficult to beat the stock market in the short term. Because in the short term, it's an expectation game. You're worth the sum of your future cash flows. We have an expectation of what those cash flows are going to be. So performance doesn't matter. Performance against expectation matters. So I can do well, just less well than you thought, and my stock price could actually go down. I could do badly, just less badly than you thought, and my stock price could go up. So that's actually what happened to Apple. So Apple was disappointing. They just disappointed a little less than what the market was looking for, and that's why their stock market went up, which is going to be confusing to people that are reading the papers, because people are going to be reading the papers about all their disappointment, and then they're going to see the stock price going up, or they're going to be like, WTF, this doesn't make sense, right? And what I'm telling you is, if you think about it, it actually does make sense, because we had a baseline, and then the baseline is the price. We got new information, and we just adjust the baseline based on the new information. And that's what's happening in the short term. That's actually why I want you to play the Bloomberg simulation for the stock trading game, because what you're going to focus on for the next 3 months is this expectation part of the marketplace, right? And that's actually how you're going to win, or at least do well in the Bloomberg Trading Challenge, is that it's really not about actual performance. And you're going to quickly realize that actual performance doesn't matter if there's already an expectation. It's performance against expectations. And one of the things that most people never see is what are the expectations for these companies. And it's almost like flying a plane without looking forward. Like you just have no idea what's in front of you. Of course you have to look forward. And so that's actually one of the nice features of Bloomberg, is you're actually getting insight that people don't see into what these future expectations are. Whether they're right or wrong, it doesn't matter. This is how companies are being judged. And that's actually what happened to Apple yesterday. One of the other cool features is if you type in EVT, that will bring you to the event calendar. And this was the conference call yesterday. Over here on the right is the audio recording, if you want to listen to the call. This was the press release, so the PowerPoint slides. And this is a transcript. So again, Bloomberg's using machine learning so that during the call, they're real-time transcribing the call. And as soon as the call's over, you get a searchable PDF. So this is a transcript of what was talked about and just, the problems and challenges that Apple was having, right? And then the third area I just want to highlight to you is BICO. BI stands for Bloomberg Intelligence, about a company, BICO, Bloomberg Intelligence for a company. Not all companies have this, but what Bloomberg has been doing is they've been hiring their own sell-side analysts, typically that work for Wall Street. And their goal is to do sell-side research with one caveat. The Bloomberg analysts do not write buy-sell hold opinions because Bloomberg is trying to be sort of a neutral data source. Okay, so not trying to be an advocate. But what they do is they aggregate all of the other analysts, and it kind of gives you like a cliff notes of what all the analysts are saying. So in BICO, this is a summary of all the analyst reports. It's actually very useful. And that's for the company. If you click over here in industry, this is a summary for Apple's industry of all the analyst reports. So again, they're updating this pretty consistently. So as of yesterday's call, these are basically what the analysts curated said about the call based on what the other analysts they've read said. But basically, you see this, that the $57 billion midpoint of Apple's fiscal second quarter revenue guidance range suggests the company will ship 40.7 million iPhones, which is 53% of total revenue, at an average selling price of $741. And this means 22.1% year-over-year decline in iPhone unit sales. So one of the other challenges that Tim Cook put on the marketplace, which is part of why people started expecting bad news, is about 3 months ago, Tim Cook said, we're no longer going to report iPhone sales, right? Now, everybody was like, that's a bad sign, okay? Because if generally you report iPhone sales when things are going well, if you're saying you're not going to report it, things are probably not going to go well. Well, a drop of 22% in unit volume is a good omen for bad, okay? So that's the point, is that this is probably why they were doing it. And they were probably hoping to mask the drop in unit volume by raising the price. But to be honest with you, I think it kind of backfired on them. I think the prices have gotten so high that's actually causing some of the unit volume declines, particularly in other regions of the world like China and India, where there's a lot of low-priced phones, and people are just like, I can't pay $1,500 for a phone when I can get one for $200 that does almost the same thing. I think even Apple is realizing the challenges that they're facing. And so, again, if you really start to do some analysis, this is what we're going to start digging into throughout the year. But nonetheless, I just wanted to kind of follow up on some comments that I made on Monday. Okay? All right. So today, what we're going to do is we're going to go over lecture note 1, which was posted on Elms, and introduce you to do homework 1, which is due 10 a.m. Monday morning for all sections. Okay? So I'm going to release homework 1 at 5 p.m. Eastern Standard Time today, because I don't want you to do homework 1 during class, but it will require the use of Bloomberg. And we're going to do similar things to what's in homework 1 in class today. And I'm recording this class, which is going to be on YouTube, so that you can use this to help you if you struggle following along on Bloomberg with some of the screenshots that you're eventually going to need to do. But as I also mentioned, that I record every class. So this will be the second recording, including Monday's class was recorded as well. Okay. All right. So let's go back to lecture note 1. So basically, McKinsey calls this the 4 cornerstones of value creation. And this is a summary of not only the readings for this week from the book, but also the themes that we're going to be talking about throughout the semester. Okay? So a few things as we get started. The first cornerstone of what drives value is about spread. That basically over time, you must earn an ROIC greater than your cost of capital to create value. Value creation begins and ends here. It's like net present value. Like if your internal rate of return is less than your cost of capital, less than your discount rate, you cannot have a positive NPV. Okay? Well, the same applies in the real world. That ROIC is the company IRR. Okay? So internal rate of return is the average rate of return of a project over time. ROIC is the average rate of a company for 1 year. But if you extrapolate it out over time, it's kind of like the IRR for the company, IRR for the project. Okay, so ROIC is the rate of return of the company. The cost of capital is the WACC. So if you look at the difference between the two, a positive spread, more ROIC than WACC, is positive NPV. Less ROIC than WACC is negative NPV. And what you need to understand is that's going to be key to value. If your spread is negative, nothing else is going to matter. You can't get a positive NPV, which leads to a very important second point. Growth does not create value. And I need you guys to understand that. Okay? And I'll just do this. Insert here a quick slide. My own little hand-drawn stuff. See if I can. What I want. I'll just do text. Okay. So, if your ROIC is 4% and your WACC is 8%, is that good? Are you creating value? Okay. If you do more of that, is that good? No, you actually make the situation get worse. That's why growth doesn't create value. If you're borrowing at 8 and making 4, and you grow that, you just get yourself deeper into a hole. So what I need you to start to understand is growth is the accelerant to value. Right? It's not value in and of itself. And this is where people get confused, because they just assume if we grow, we're going to create value. No, because if you grow a negative spread, you're just going to make the situation worse. So if you can borrow at 8 and you can make 14, do you want to do more of that? So that's the point. It's the growth spread combination. And that's what I need you to start to understand. That is the key to value creation. So if I have the opportunity to make a positive spread, step on the gas. If I have an opportunity to make a big negative spread, step on the brake. Right? That doesn't mean that it has to be a positive spread every single period over time. Like, I'll spend money now if I think I have a reasonable shot at making a positive spread later, but I got to believe it's going to be a positive spread later, right? And that's key to the conversation. So what I'm saying is growing just to grow doesn't create money. Even with the internet companies, we're like, I'm just going to spend money to create eyeballs. At some point, there had to be a belief that those eyeballs would turn into dollar bills. Because if I can't eventually monetize that, it doesn't matter. Matter of fact, that's one of the problems that companies like Snap are having right now. Is Snap is having trouble after giving it away for free to get you to buy ads. Right? People are just not clicking on their ads, and it's really bad for their platform. Right? And so therefore, it's not getting the value that everybody thought it was going to, and the stock price is reacting appropriately because people are now changing their view that Snap is more like a hobby than a business. Okay? And by the way, hobbies are probably not going to last. That's even if you guys are even using Snap anymore. Does anybody here even use Snapchat? Okay. Anybody use MySpace? Seriously, like, is Snap going to make it in 10 years? You still going to be using Snapchat? Everybody's laughing in here. Some people are saying yes, some people are saying no, but that's not a good endorsement for Snapchat. And that's going to be one of the cornerstones we're going to talk about later, which is how durable things are, right? But the first key point is spread. You got to have a spread, right? Right behind this is that growth is an accelerant to value, okay? And then here's the other final key point I want to start with today. Half of a spread for a company is the industry that it's in. The industry is more important than the company in terms of a return, right? And I want you to think about this intuitively. If I'm in a bad industry, it doesn't matter how well I do, I'm going to have trouble making money. If I'm in a great industry, I can be mediocre and still make a lot of money. So when Warren Buffett actually invests, that's what he says. He says, I don't invest in companies, I invest in industries because the industries are more important, Then I pick the companies. Because if I just pick a company and I pick it in a bad industry, I'm not going to do well. So I need both. And actually, the industry is even more important than the company. I got to put myself in the right industry, then pick the winners. So I want you to start understanding the importance of industry. And that's actually where Bloomberg is helpful, because this is, in my opinion, one of the most powerful features of Bloomberg. There is no other tool out there that does what we are about to do, and you're going to completely take it for granted. Okay, that's why I kind of joke with the Maryland faculty that if you pull Bloomberg from me out of my cold, dying hands, I quit. It's the day I'm gone from the school, because I wouldn't even know how to teach a class seriously at an academic level without the tool that we have. Like, I don't even know what the other faculty do. Okay, and so seriously, and I'll give you an example of this. Give me any company, any publicly traded company. Facebook, FB. So you type in FB, down here, it searches for them, U.S. equity. Okay, we'll look at their Class A shares. Got the real-time quote across the top. But this is the powerful feature. It's called RV, which you can either get it off the menu down here, or just type in RV across the top. Hint, you're going to have to do this for your homework assignment. So RV stands for relative valuation, which is basically a pure analysis. So you hit enter, and it will by default give you Facebook and all of its peers and a bunch of data. Okay? But I first want to start out with the peers. Now, your screen probably looks like, actually go to custom first. Your screen doesn't look like mine because you have to go here to settings and then global settings. And this will be stored within your Bloomberg account, but there's a couple of global settings that matter. One is across the top, show top section. I want you to unclick that because I think that this ugly top section is completely worthless. So just get it out of your way because there's really no value to it. Okay, so settings, you'd rather see more companies. So unclick the show top section. Next, under stats, make sure the market cap weighted average is checked. Okay. So what Bloomberg will do is every time it loads a list of companies, it can perform some statistics on the data that it displays. And the stats, the very first line that I want on there is called the market cap weighted average. Because what that's going to do is it's going to give us an industry average. And it's going to be weighted based on the size of the company. So some tiny company doesn't distort the average of the industry. So I don't want to use the stat average, because if I use the average, then Facebook and Snapchat have the identical weight in this industry. And that's not realistic for the market because Facebook is a giant and Snapchat is a flea. Okay? So the point is I need to wait for the size to get the performance. Market cap weighted average. And then the final thing is Excel export mode, static data. Make sure it says static data, not dynamic link. Now, one of the coolest features of Bloomberg is the dynamic link. Right? You can't use it. Okay? And here's why it's cool. Because if I go to a screen, I can export it to Excel. Anytime I open up that file in Excel, it'll do a real-time pull from Bloomberg and auto-populate the Excel file. Really cool. But in order to do that, you have to be at a Bloomberg terminal logged in. Because if you're not at a Bloomberg terminal logged in, when you open up the Excel file, it'll say, can't find Bloomberg, error, and it'll just say error throughout your whole spreadsheet, and you won't have any numbers in it. If you were to turn this in as a homework assignment in the class, the TAs will give you a 0 because they can't grade a file that says error. Okay, so that's the thing. Like if you actually could bring the lab outside the lab and open it up anywhere, it's actually pretty cool. Okay, because then you can do some real custom spreadsheets. Unfortunately, because you're stuck to the lab, you want to basically take static data, which means anytime you export to Excel, it exports just the numbers. So that way, if you leave the lab or submit a homework assignment using the Excel data, then it actually is numbers. So make sure it says static data. Once you close that, your screen should look closer to this. Okay, and then finally, under settings, global settings, under comparables, I want you to, just so we're all using the same data, Bloomberg has several comp sources. I want our default comp source to be Bloomberg, which means Bloomberg will actually create a list of peers for a company using an algorithm. So we want to use Bloomberg's algorithm. Now we could choose to use what's called the GICS, which is the Global Industry Classification Standard, as a second way of doing this. That's an 8-digit code. It's 8, 6, 4, and 2. It's like, I think it's like sector, industry, sub-industry, and something else, okay? But it gets more narrow, and that's like a traditional classification for companies, but it's pretty broad. So we want a more narrow classification. We might change around, but we're going to use default Bloomberg comps. Region filter, country of dom means country of domicile. So by default, whatever country that country is based in will be the default competitor list. Can't talk today. And then finally, max number of comps, change it to 50. So that means by default, it's going to put 50 or less companies in there. So if there's like 200 companies in the sector, it'll just do the top 50. Okay, just so we're all using the same average. Because in the last class, somebody said, oh, I'm getting a slightly different average than you, because he had a different number of competitors that Bloomberg was calculating the industry average. So we're going to use 50. Not all industries have 50. Facebook, you can see, only has like 4 or 5. But nonetheless, we'll use up to 50 in our industry average calculation. Okay. Now we all have the same data. Close that. And you're on a blank screen. So these are, right now, the GICS competitors. So let's just practice. So this would be the Bloomberg list for companies in the US. If I switch here to GICS, this is based on the Global Industry Classification Service competitors. Much bigger list. So let's stay with GICS. And region, these are the global peers of Facebook, or these could be the US peers of Facebook. But because Facebook is a global company, let's stay with the global peers. All right. Now, where it says add column, I want you to type in ROIC. This is the return on invested capital. Click on that. And it'll ask you which period do you want to get the ROIC for? Because again, with Bloomberg, I can get ROIC for any period I want. Pretty cool. So we're going to do it as of the latest filing. Annualized as of the latest filing. So click on that and hit enter. So across the top on the left, this is the ROIC as of the latest filing. This is the market cap weighted average. This is the industry average ROIC for Facebook's global peers. 17%. Facebook, based on its last quarter, 25%. Okay. Next, I want to do spread, so I want to enter the WACC. Add column WACC, weighted average cost of capital. Hit enter. That's the industry WACC across the top in real time. Every time you load this screen, it's going to use real-time data to calculate a WACC. The top line is the industry average WACC. The next line is Facebook's WACC. So last thing is I want you to save this template because we're going to use this template a lot. So this is why you're getting certified, by the way. You're going to learn how to do this as part of your Bloomberg certification, but to speed things along for homework 1, I'm teaching you some of the basics today. So there's this little gear icon over here. It's like a gear. Click on the gear icon. Save as new template. This will allow you, if you start creating these custom fields of all the data that you want, it'll allow you to save it as a template that's reusable. So it's just one click, pulls up the template. So name your template whatever you want. I'll call it 443 spread. And then save it. And then I'd already did in the last class, so I'm overwriting what I had. But across the top, in this line, are the templates. So that way, for example, I had done a multiple template previously. So there's my multiple template. Here's my spread template. So I have a bunch of templates, okay, already saved. You'll start, as you save them, they'll be on this menu bar. Just quick access. So here's the point, though. This is Facebook's industry as the latest filing globally. Now, is this an attractive industry right now? Yes or no? What do you think? Yeah.
Yeah, it looks like the ROIC is a lot higher than the WACC.
Exactly. So what he just said, the ROIC being higher than the WACC, is exactly how we're going to define an attractive industry. So for our class, an attractive industry has a positive spread. An unattractive industry has a negative spread. Okay? Because what's attractive is value creation. And right now, this industry is creating value. Now, two things about his statements. On an exam or homework assignment, if I ask the question, is this an attractive industry? And even though he got the correct answer, the TAs would be instructed to give him a 0 and no credit for his correct answer. And this is very important, which is why I'm putting it on video for this class. And it's actually good for your careers, but it's important for this class and very critical. If I ask you if it's an attractive industry and you say yes or no, it's like flipping a coin. It's a 50% chance of being right or wrong. And if he said yes, I don't know he said yes because he guessed correctly, or I don't know he said yes because he actually knew the right answer. I can't distinguish, and it's 50-50. All right? And in a lot of other classes, you probably guessed your way through without actually knowing anything. And that's okay. I'm not going to bemoan you for actually playing by the rules. So here's the rule in this class. You must use numbers with your statements. No numbers, no credit, even if the statement is right or wrong. That is the only way we will be able to tell when we grade you whether or not you know what you're talking about. So let me reframe his answer. Is this an attractive industry? Yes, 0 credit. Is this an attractive industry? Yes, because the industry earns a 17% ROIC against an 11.65% cost of capital, resulting in a spread of over 5 points, and that's what makes it an attractive industry, A+. That's what I need you to practice on. Not just for this class, but I'll tell you it helps you in the real world. Like one of the reasons why I am good in the corporate environment, including yesterday when I was working with a company called Merck, is because I refer to numbers. Because when people listen to me, they can follow what I say. When you see a crowd and there's a bunch of people looking at a bunch of numbers and you're just talking, they have no idea what you're talking about, even if you do. You get better, and it gives you much more credibility when you can actually refer to numbers. So it is a requirement in this class to use numbers in every assignment, in everything you do. It will make you a better analyst, right? And it's important because it will get you the grade that you want to get in this class. So must use numbers. Second definition that we're implying here, attractive industry, positive spread, is I want to use a different definition for competitive advantage in this class than what you probably used. Most people believe that everybody is good at something. Okay, so we're talking about competitive advantage, everybody's got a competitive advantage. But that's mathematically not true. So the definition for competitive advantage that we're going to use in this class is you must outperform your peers. Right? If you're average or below average, you don't have competitive advantage, right? And I'll proxy this to basically say there's an industry rate of return, and you might make money because you're just in a good industry. It doesn't mean you're good at what you do. You're just in a good industry. If you're really good, you're doing better than the other people in that industry. So performance relative to peers, specifically outperforming your peers, is a sign of competitive advantage financially in this class. So in the context of spread, this is an attractive industry because it's 17% ROIC against 11.6% WACC. Does Facebook, using this definition, have competitive advantage? Yes or no? Yes?
Yes.
Who said yes? Okay, why?
Because they have a much higher, they have much more ROIC over the WACC than the average.
Okay, so I really want to give you credit on that assignment. So keep going.
I don't know how to keep going.
All right,
You're gonna have to
phone a friend. Help him out. He said the right statement. What do I need to still hear?
They have a 13-point spread over the average.
There we go. Exactly. I said it's going to take practice. You're going to get used to this, and it's going to become second nature eventually. but you're going to not realize how much better that makes you sound. Even in interviews, it's going to differentiate you from other students. Because when you're just talking generalities, we don't know if you're just slinging a bunch of BS. We really don't. Use numbers. It'll add to your credibility. So that's the point. Facebook's ROIC is 25. The WAC is 12. They have a 13% spread in an industry that's about a 5.5 to 6% spread. And that's why they're demonstrating competitive advantage. Okay? Does Twitter, using this definition, have a competitive advantage? Is Twitter demonstrating competitive advantage? Yes.
I'd say not really, because their spread is about 5.5 points, which is the same as
Okay, so 14.3
maybe some.
versus 8.6, 5.7, and the industry is 5.3. So actually, you could argue that the 5.7 is a slight competitive advantage. I mean, it wouldn't be like, oh, Twitter, they're really, really good, right? They're doing a slightly better. But technically, we could say they have a little bit of a competitive advantage. And I'm just saying, this is the way I want you to interpret this. So the answer is yes. Magnitude maybe not as high, but the answer would be yes. Okay, everybody with me on that? Okay. So here's the next thing. Let's look at a different industry. Give me another company.
Data.
Data?
DA.
DAN? Okay, so where it says FB US equity, not the top line, but in this thing, type in a different company. He said DAN, which is Dana. Okay, so I don't know who Dana is. We're about to find out. So who is Dana? What do they do?
They make car parts, like a drive shaft.
Okay, so drive shafts. So probably auto parts manufacturer for the selling the automobile industry. Again, if we're using the analyst curated Bloomberg car parts industry, is this an attractive industry that they're in? Global car parts, based on this list. Is this attractive industry? Yes, it is. Why is it an attractive industry? Because 10.49 is greater than 8.6. How is Dana doing? Sad? Dana's very sad. Okay. I don't know if we give you credit for that, but we get a good chuckle in the grading part. Dana sad. Okay. Dana not creating value. Dana have negative spread, 7.42 against 7.37. So Dana not doing well in an industry that's creating value. Okay. Now, don't get me wrong. They're doing better than Hyundai. Hyundai WI Corp is doing pretty badly. They're borrowing at 5 and losing money. So I'd rather do Dana than Hyundai. But nonetheless, that's the way I want you to think about this. Right? What about the car companies they're selling to? Here's Ford, F, US equity. This is global auto, according to GICS. How's global auto look? That's pretty bad. And Ford's doing pretty awful in an awful industry. Okay? So that's just something to understand. I mean, that's actually one of the problems. Take a car that you probably use 10% out of a day, and we basically have this underutilized asset, and we're selling more and more people into a market of saturated, underutilized assets. And that's the problem that the automobile makers are basically having today, is that there's just a glut of cars, and they have to figure this out. In fact, what they're really trying to figure out now is, instead of selling you the next car, how do I get better utilization out of the cars that I sell? So they're going into, for example, the subscription business, right? That's why you're seeing companies like Volvo and Cadillac, Mercedes, BMW get into subscriptions, because they're realizing that they can't keep selling you cars that you barely use, and they got to get more out of the cars that they sell. So I'm not saying it's the only answer, but they have to readdress things, because this industry has a huge amount of capital for not great rates of return. Okay? Yes?
Is it ever possible for the company with the highest market cap, it has a negative spread, but the industry itself is really good?
I mean, it would basically be the big companies doing really poorly and everybody else is doing well. It's possible, but I haven't seen it recently, but I'm not saying it's not possible. So as I said, what I like about your question though is actually very important, because what's important in this class is we have to get beyond our biases. That's the other key part of this tool, is that, you'll say, oh, well, this industry's bad. Well, if you look at the data, no, it's not. Or this industry's great. If you look at the data, no, it's not. So I think what we have to find is, this is where the EQS tool, by the way, could help. Like if you go to equity screening tool, EQS, we can actually have somebody do a search for that, which is look for somebody with a high market cap and a low spread, and then quickly see who those companies are. And then we can see if they are outliers to their peers. So that's more than I need to, because I get this things today, but that's something we could actually do. So good question. But here's what I want to quickly show you. I'm going to go to Starbucks because their former CEO is running for president. Starbucks US equity. Fast casual, US. How's this look? Look at Domino's. 105. Remember that next time you order a pizza. ROIC. For every dollar given to these companies, 30.07 cents of after-tax cash profit last year. Domino's, for every dollar, $1 of after-tax cash profit last year. This whole industry is doing really well, with the exception of Aramark, who I was working with recently, and Chipotle. Well, that's what, getting really sick causes problems with customers. All right, E. coli bad for Chipotle. Here is airlines. How are airlines doing these days? United, Delta, Southwest, how are they doing? I'm sorry? Okay, so let's look. Here is UAL. Is this an attractive industry? Yes. Does United have a competitive advantage? Well, we're about 4.2, 4.3 for the industry, and we're about 3.9, something like that, for United. Not really. But again, the airlines are actually somewhat attractive right now. Right? Historically, airlines have not been doing so well. One of the reasons why is the second biggest cost of airline, which is 22% of the average airline's cost, is fuel. And right now, oil prices have a big determinant about whether airlines make money. Matter of fact, in Bloomberg, you can actually type in the price of oil. And if I want to look at West Texas crude, type in GP, which is graph. That's oil prices for the last 12 months. If I click on 5 years, that's oil prices for the last 5 years. Oil prices were 100, now they're 55. Right? If oil prices are half of what they used to be, it's a lot better for the airlines. So to be honest with you, why are airlines doing well now? Because the price of oil is half of what it used to be, and that's 20% of their cost. I mean, it really is simple as that. So as long as you don't screw anything else up, and you're going to do well in this market today. Okay? But that's the flip side. If oil goes back up as it was to 75, 80, people are going to be freaked out about the airline industries because suddenly their costs are rising and it's hard to pass it along to consumers in the short run. So long story short, they're tied to the oil and gas industry. Interestingly, give me an oil and gas company. Exxon. Do you think Exxon did better here at 100 or here at 55? Serious question. Where did Exxon do better? It's not a trick question, it's an actual question. Well, XOM, RV, custom, click on my save template. Right now, the oil and gas industry, it's called fugly. Look it up. Okay? They're borrowing at 9.9 and they're making 7. At $50 a barrel, this industry is like autos. No one's making money. It's hard to make money. Interestingly, if I added a column here by clicking on the gear, I can do an ROIC for a customized period years ago, Y minus 4 or 5, when oil was $100 a barrel. $11. It wasn't the best of times. It was just better. It was positive spread territory at 100, negative spread territory. That's what I'm saying. When oil goes to 100, they're not like Starbucks. It's not an overly attractive industry. But it's the difference between a positive and a negative spread in the industry. But if you wonder why Saudi Aramco pulled their IPO, this is why. Because at today's oil prices, nobody wanted to pay $2 trillion to own part of Saudi Aramco. It just didn't make any sense given the spread. Made sense to the Saudis, just didn't make sense to anybody else. But the Saudis also set their budget as if oil was 72. If oil's below 72, the Saudis run a budget deficit. So this actually has political implications as well, because for Saudi Arabia and some of the other countries that rely on oil, including Venezuela, $50 oil is very bad. They can't function as a country because their budgets expect oil to be higher. Okay? But nonetheless, that's beyond the scope of our class. But the point is, I can tell you all day long, in the book, the academic articles say that different industries have different spreads. But with Bloomberg, I can show it to you. And that's what I need you to start to understand. There are different attractive industries at different growth rates, at different rates of return. And that is what matters much more than our bias. Okay? And what we have to figure out is not just what the spread is today, but what it's eventually going to be tomorrow and how our company is going to play. Right? And so that's the first cornerstone. Continuing on, cornerstone number 2. It's about cash flow, not accounting. Do that one very quickly. So basically, and this is in the book, but valuation is tied much more to cash flow than net income. Net income is a representation of the cash you'll eventually generate, but as finance people, we know time value of money. That the timing really does matter. And so therefore, cash flow is a better predictor of price than net income. That's why we focus on cash flow. Cornerstone number 3, expectations. Everything we're talking about this semester was invented at the University of Chicago, mid-1970s. That's where modern corporate finance was born. When I went to Wharton in the 80s, my professor came from Chicago in the 70s. They wrote all the initial textbooks. They basically disseminated everything we did. And one of the things they did was a very critical database, which relates to Cornerstone number 3 in 1976. That they created a 50-year database on a punch card mainframe computer covering 1926 to 1975. And they put in stocks, bonds, and real estate. Basically on a quarterly basis, cash flow and price on thousands and thousands of stocks, bonds, and real estate assets in the U.S. And in 1976, what the quants found was that there was a 1-to-1 correlation between cash and price. Whatever cash the assets generated, stocks, bonds, or real estate, became their price in the marketplace, real world price. Today, we call that intrinsic value. The idea that you're worth the sum of your future cash flows is something Chicago proved actually happens in the real world in the mid-1970s. By the way, they've updated that data set, 1926 to 2018. Nothing has changed. There's a guy named Jeremy Siegel, professor at Wharton. He went back to 1812 because we actually have data in the U.S. to 1812. And 1812 to like 2010, nothing changed. Cash equals price, right? They've replicated that data set in Europe, Asia, Latin America, Africa, Australia. No matter where they went, cash equals price over the long run. And so that's the point of intrinsic value. You're worth the sum of your future cash flows. And that's key to valuation. So that's the point. Valuation is you're worth the sum of your future cash flows. And that is the inherent problem with what we've been doing for the last 20 minutes. What's the problem with the data on this screen. Yeah,
It's current.
that's right. I'm looking backwards. See, this is the trick. How do we do analysis? We look backwards. What you did last year doesn't matter. This is irrelevant to your valuation. I don't get last year's cash flow. I get next year's cash flow. So I care more about the future than the past. The fundamental difference between finance and accounting as a discipline is accountants look backwards. Finance people look forward. If you really want to be a good finance person, you got to look at the future, because that is what value is all about. And the problem with financial statement analysis is we assume the past repeats itself. And it does until it doesn't. And that's the problem. If you looked at Apple, you'd have been completely hosed, because you could not have predicted, given their past performance, that their stock was going to drop 30%, because for the last few years they've been so dominant. There's nothing in their historical results that would have showed you that. And that's why it is so difficult to just look at the past. And that's the thing that we do. We all look at the past. We study the past. We analyze the past. We ratio. We benchmark, right? And the problem is the market is like a sine wave. It's not a line. And we assume it's a line. And that's the problem. So one of the things that you have to start doing this semester is you got to look at the future, right? Because pricing is based on expected cash flows. So here's the rub. What matters is how much cash you're going to generate in the future, and to price you, I need to know today how much cash you're generating in the future. So a couple weeks ago, I was actually working with a company called Aramark. We were in Florida. In the room was their chief financial officer. And I was kind of half joking, but I was like, hey, Aramark CFO, how much free cash flow are you going to generate to the nearest billion in the next 10 years? And the whole group laughed. Because even the CFO of Aramark would have had to make a guess. Now, it's a more educated guess than the rest of us, but to really narrow it down for 10 years of total cumulative free cash flow, like, it's a guess, because there's a lot of risk. A lot of things could happen in 10 years. Yet if I'm pricing Aramark, I have to make that guess today to get their stock price. Otherwise, how do I create the stock price? And so that's the point. What Chicago proved is today, it's guesses. Tomorrow, it's what you actually do. We adjust. What just happened to Apple? Apple had consensus estimate. Guess, this is what I think Apple's going to do. Apple then tells us, no, this is what we actually did. Stock price adjusts. So that adjustment is always happening. What Chicago says is eventually you're going to get to that intrinsic value. But here's the problem. There's very few always in finance, but here's one of them. You never get to the future. Like, even if I knew what the next 10 years was, by the time I got 10 years from now, if I jumped into a time machine, the last 10 years don't matter. It's the next 10 years. So price is always expectation. Whether stocks, bonds, or real estate, price is expectation. See, fixed income is easier than equities because promises are made. There's a contract. You're going to pay this interest rate at this period of time in this amount. But there's still risk because there's no guarantees that you're actually going to follow through. You could default. Equity is easy. I can teach a 12-year-old, seriously, to do the math required in this class. That's not the hard part. It's algebra. It's actually just a growing perpetuity. That's all equity analysis is in terms of the math. The hard part, what are the numbers you put in? Because those are not certain today. So that's the art of valuation. It's not the math. It's figuring out what the actual numbers are going to be. And that's not easy when you look into the future. So here's the thing. The one value of Bloomberg, which is why I said I don't know how you'd even teach a class without it, is this is one of the very few tools that you can buy in the world today that gives you a real-time view, crystal ball into the future. Because it's giving you the expectations of the people who matter, the people that are actually guessing the future. And that's the consensus estimate overview. So if I pick a company like ExxonMobil and I type in EEO, this is Wall Street's guess of the future of ExxonMobil. It's a guess of their revenue, it's a guess of their profits, and it's a guess of their free cash flows. So if you're worth the sum of your free cash flows, these people, the analysts that create this forecast, set the baseline. Right? Now, it's not saying that they're right. It's a wisdom of the crowd, though. And these are the specialists that are not insiders of the company that know the most about the industry. Because the whole point of these analysts, and you can see this in ANR, is the analysts that are covering ExxonMobil the 26 of them on this list, like Paul Chang of Barclays, okay? Now, we are not authorized under our educational license to see his actual spreadsheet for ExxonMobil. That's why there's a little lock on there. But if you IM him and he gives you ability to, you can actually see his forecast for Exxon. Okay? Because that's the point. These analysts have to create spreadsheets, just like we're going to be doing this semester, forecasting these companies. They upload it. And what they have, and you can see this if you click on Paul Chang, is he's got a pretty big coverage universe of 21 oil companies. Most coverage universes are about 10 to 15 stocks. So typically at a Wall Street bank, you got 3 analysts, the main analyst and 2 sub-analysts, usually 1 undergrad. And that team has a coverage universe, and their entire life is to be specialists in that industry. He's specialist in oil and gas. So his whole life is to cover these 21 companies and write research reports and basically create forecasts. But here's the one thing that Paul can do, which is, Exxon, are you affected by Venezuela? And oh, by the way, is the Venezuelan crisis going to affect the price of gasoline? What he can then do is he can call Chevron, he can call Hess, he can call Conoco, he can call Valero, and he can ask the same question. So if nothing else, any one of us can call these companies. We'll never get through. He's got the CEO, CFO, and investor relations on speed dial, and anytime he calls, Paul, what can I do for you? And that's the value that these analysts can really provide. That's why they're helpful. And by the way, I say he, here's his bio. There's Paul. Doesn't look much older than you guys, working for Barclays. That's his phone number in New York. That's his address. That's his email at Barclays if you want to stalk him. But I'm gonna take a side point. How bad do you guys want to work on Wall Street? Because this tool gives you actual contact information, cell phones, emails, IM through Bloomberg of every analyst, every Wall Street firm. It also gives you every Maryland grad at every Wall Street firm. And I'll just ask you, how bad do you want to work on Wall Street? Because you want to work on Wall Street, call them up. You might get a lot of rejection, but I'm just telling you, you have the contact information to everybody on Wall Street through Bloomberg, right? PIAP, you can also search, and you can find out who are all the Maryland grads, undergrads that are working in all these firms, and you can reach out to them. I'm not saying they're going to help you, but I'm saying you have a tool. Okay, so back to this. He's actually a little bit older than you. He used to work for Lehman before they went bankrupt. Now he's at Barclays. Anyway, still looks like a kid though. All right. Anyways, rich kid. All right. So back to this. So the consensus estimate overview is the baseline. It's the cash flow. It's very important. All right. So here's the thing. If I look at a company like Amazon very quickly, and I go back to RV, and I go back to our custom tab, and if I use GIX Global, because I want to include companies like Alibaba, okay, if I'm going to really do companies that are similar in peers to Amazon, Tencent, etc., and JD.com. So if I use my spread template, that's the global spread. Is this an attractive industry?
No.
Because?
It is a -6 spread right now.
Great answer. How's Amazon doing?
They have a very big competitive advantage.
They have a competitive advantage. They're making a 1-point spread in an industry with -6. Which somebody asked the question last class, can you actually have a negative spread and a competitive advantage? By this definition, yes. You could just be doing relatively less bad than your peers. Okay, but the point of the story is, why is this company now more valuable than Apple? And I'm just telling you, this is the problem with historical analysis. Like, you can get your calculators out and you can solve this problem all day and you'll never come up with an answer. But here's the wisdom of the crowd. I don't care what these companies are making on this list today. I really don't. So this is the problem with accounting. What is this data? This is past. This is last year. I don't get last year's cash flows. I get next year's cash flows. Is last year representing the future? It's like driving a car in the snow looking only in the rearview mirror. Okay, good luck making it that far. By the way, don't take the Bird Box Challenge, whatever it's called, Bird Cage Challenge, Bird Box? Bird Box. Don't do that. It's really dumb. Okay, but that's what you'd be doing if you're looking at historical numbers, and you don't have a bird chirping away. So, EEO. I want you to look at row 13. That is organic growth, no acquisition. I want you to look at row 16 and 17. And I want you to look at row 29. That's why Amazon is so much more valuable than it would look based on their ROIC and spread. I was like, oh, they're not creating value. I don't care. Look what they're going to do in the next 4 years. They're going to double in size. Their free cash flow is going to go from, what was it, $6.5 billion last year to $46 billion in 3 or 4 years. I'm willing to wait if I think that this is a realistic possibility. And Wall Street thinks this is a realistic possibility. That's why their stock is trading at $1,600 a share. And I'm saying, without looking at this data, you just think that the Wall Street people have been smoking dope. I mean, it just doesn't make any sense. Like, how could they do this? They're just all money grubbers. No, they see the future, and this is the realistic future. And by the way, Amazon's biggest challenge is not exploding as they get to this size. Everybody realizes they hired 1,000 MBAs last year. That was last year. That's even before they got to this size. I was talking to Howie Caulfield, who runs the MBA admissions for Wharton MBA. We're doing a class together. And he was telling me at lunch, he said, Amazon was the #3 recruiter at Wharton last year. They literally showed up and they hired everybody that walked in the room. Like, if you had a pulse and you were an actual Wharton MBA, they hired you. And they would have hired more if more were available. And by the way, they didn't just do this at Wharton. They went to every major business school. They went to NYU, they went to Columbia, they went to Stanford, they went to Chicago, they went to Berkeley. They just basically just hired them all. I hope they came to Maryland, right? But that's the point. And this year, that was, as a $177 billion company, they're going to be a $400 billion company. So when they said they're putting, 25,000 employees that make more than $150,000 a year in the DC area, that's the point. They got to go staff this thing. And these people have to be in a company to actually execute, to not screw this thing up. That's where people are getting nervous, which is, can they actually do this? And what Jeff Bezos is, I'm just going to hire the smartest people I can find. All of them. Okay? So back to recruiting. Like, I don't know if you guys want to work for Amazon, but I know they're hiring. Right? And they just need smart people. So that's the point. And they're going out there and they're looking for smart people very aggressively. Versus, and again, not to be unfair to Apple, but this is Apple's challenge. As great as Apple has been, look at this future and look at revenue, which is line 13, right here. They're kind of growing, and their free cash flow is kind of consistent, but that's the point. They're just now a mature company, and they're nearing the end of their product life cycle, and people are getting really worried that the iPhone could actually fall off a cliff. And Amazon just still has open road ahead. So yes, Apple's today absolutely outperforming every company in the history of the world and every financial metric you could ever measure on. It's an amazing historical feat. But they're not the company of tomorrow. And that, again, should not be a surprise, because that is cornerstone number 4. Cornerstone number 4 is competitive advantage. It's fleeting. Nothing lasts forever. Something like over half the S&P 500 has been gone in the last 18 years. And it's expected to be gone in like the next 10 years. Like, just things change. The world changes. So the definition of competitive advantage has now changed. The 20th century was defined by Michael Porter of Harvard University. 5 forces: competitive advantage, moats. You build a castle, you build a defensive moat around it to keep people out. You got to have some advantage, because that's how you're going to make money. All right, especially if you're doing well, people are going to attack you. You got to have a defensible position. You need a patent, you need a brand, you need a technology, you need a regulation, you need a cost advantage. You better have something, otherwise you're not going to justify that price premium, or you're not going to get that lower cost. So you need to have a moat. And Warren Buffett is a moat guy. He won't invest in you unless you have a moat, because he needs to make sure you have a defensible position. But the 21st century is defined by waves. What if nobody wants to invade your castle anymore? Your moat doesn't matter. What if your BlackBerry or Nokia and Apple shows around with a touchscreen? The world went from keyboards to touch. Oh, it's just a toy. They'll never want to get past these little keyboards with your thumbs. Steve Jobs, it will be a failure if anybody uses a stylus anymore, because we could just use our fingers. And that changed the world. Apple clearly changed the world. But you know what? Voice is the new touch. Apple, why would anybody want to use their voice to control something when you can easily do it with your fingers? Why would you want an Amazon Echo? Why would you want a Google Home? Why would voice activation matter to you? You really like to use your fingers and touch. Stick with the touch. Don't go to the voice. Seriously, that's Apple's problem. Apple is trapped in the same quicksand that BlackBerry and Nokia were trapped a decade ago. The world has moved on, and Apple is fighting yesterday's battles. And the world is moving to voice as the new interface, and Apple is not. And that's why people are struggling. And that's why in other markets, people are accelerating away from them, and they're flailing. And by the way, that should not be a surprise. And it's not a surprise because this is not an indictment against Apple. This is just what happens in the real world. This is what all the academic data says, is that competitive advantage is a wave. It's not a question of, do you have advantage? It's a question of how long. All waves crash. And, like a good surfer on Bondi Beach, what's the next wave? I care about the markets that are attractive in 5 years, not the attractive 5 years ago, 5 years from now. What's next? That's where I'm going to make my money. I'm not going to make the money in the markets of yesterday. That's GE. GE is in the markets of yesterday. They're falling. Doesn't matter how good a company you are. No one's going to succeed in that environment. And what I'm telling you is it's not an indictment against GE. It's just that's the way the world works. So as analysts, we have to be productively paranoid about the companies that we analyze. And we have to assume that nothing's going to last forever. And it's not popular. Like when I work with Google, and I work with them at least 3 times a year. I teach at the Google Marketing Academy at Wharton. I got all the top product designers or product managers in there. And I tell them, I said, these are the good old days. It's just a matter of time before what's happening to Apple happens to you. And it's not an indictment against you. It's just you have to constantly be reinventing yourself and figuring out what the next wave is. The one difference is between Google and Apple is Google has Google X. Like Alphabet is all about doing crazy stuff. And it's not just crazy stuff to crazy stuff. It's they realize that the ad business is going to start to go away. It's already happening. And they're trying to figure out what do they do when the ad business goes away and they don't make all their money on search, right? And will they find something? I don't know. But they got to try. And I think that's the problem with Apple is they haven't figured out what's next, at least not publicly, and nothing that anybody's actually figured out that they've said, and that's their problem. But what I'm telling you is insert the company here. Everybody's going to go through that. So that's what we have to start looking at analysts is nothing will last forever. Good example, Coke, KO US equity. I want you to look at these revenue numbers. Look at row 13. This is Coca-Cola. I'm looking around the room. Is anybody drinking a Coke? Diet Coke? Why not?
Maryland campus.
Okay, that's true. We are a Pepsi campus. That is fair. But I don't see many Pepsis out here either, do I? What's the real problem here?
Healthy lifestyle.
Yeah, sugar. They're sugar peddlers, and we've decided that sugar's bad for us. And if you really want to see how bad it's got, walk into your average 7-Eleven and see how much space is in those cabinets now for sodas. Walk into the supermarket aisle and see the shrinking amount of space for sodas even in the supermarket aisle. People just are not buying as much soda. So Coke is a wonderful company, managed, built to last for the long run. But what do you do when the world has woken up and said, we're moving on to sugar? And they got to figure out what's next. And the short answer is they haven't found a solution yet. Ironically, what everybody in the M&A world is telling them to buy is who? Who's the rumor that everybody says they should go buy? No, before that, Monster. So the rumors are they should go buy Monster because Monster's doing really well. I'm saying play that one out. You really think people are going to want Monster into their future if they're worried about sugar? Like God knows what's in that drink. Okay, but that's the point. So that's the idea. Is now they're having to experiment with cannabis-based drinks or CBD or whatever the oil stuff is, because that's where the world is going. You know, and so that's the point. Like I got to figure out what's next. And 10 years ago, if you told me that Coke would be, you know, looking at cannabis-infused drinks, I'd have thought you're nuts. If they don't have a choice. Matter of fact, in Tokyo, anybody here from Japan or been to Tokyo? What do they test marketing in Tokyo for Coke? They test marketing for about 6 months in Tokyo. It's actually been very successful. Yeah. Alcohol. Coke is selling alcohol drinks in Tokyo. Alcohol-infused Cokes. They're using it like the fruity drinks. Almost like, think of like Fanta with tequila in it. Just open it up and start drinking. Buy it right at convenience stores. And I'm just telling you, that's not Coke's legacy. It's like Disney selling porn. Right? You just don't expect that Disney's getting into the porn business, but one day, post-Avengers, you never know. You never know where they're going to have to go. So I joke about this, but in all seriousness, you need to think about it this way. Nothing lasts forever. So does a company have an advantage, and what's next? So 4 cornerstones of value creation. Number 1, spread. Number 2, cash flow. Number 3, expectations. And number 4, advantage, which is a wave. Wave theory. Advantage is fleeting. It's transient. Those are the things that are going to be key as we go through the semester, and a data set that's going to help us. Now, I got one more thing I got to do, and I'll turn you loose. This could be very important for your homework assignment. So let's say we are doing Coke spread, and I go to RV. Hint, hint. And I go to custom, and I put up my template. And I had to make a decision. Is Coke in an attractive industry? Yes or no? Coke in an attractive industry? Yes or no? Why? This is your practice. Yes. Great answer. Make sure you write that on your homework assignment. Okay? Is Coke demonstrating competitive advantage? Because their ROIC is 2 as against a WACC of 7.3. By the way, see Monster? That's why people are saying go buy Monster. Seriously, this is how you make money as an investment banker. You're like, go buy Monster, making 24, throw it into Coke, you're in this fast-growing Monster business. But I'm just telling you, if people are getting away from Coke because I think it's unhealthy, I just don't know how Monster is going to sustain this long-term. Right? So, again, you know, whatever it is, maybe I'm wrong, but the point is that's actually Coke's real challenge. But it's not just a challenge today. We can also look to the future in the EEO to see it tomorrow. But here's what's relevant to your homework assignment. If I were to give you a company and industry in order to prove the data that you write in your statements, again, you need a screenshot. So you're going to have to submit a screenshot. And how do you submit a screenshot in Bloomberg? Again, you'll be certified, but I'm going to short circuit this. Across the top, it's kind of cut off at the screen in the room, but there's 4 little icons in the upper right-hand corner of Bloomberg. One of them looks like a square. If you click on this, take screenshot. Save it. It'll give you a GIF file. Name it whatever you want. Okay? So in this case, if I'm taking the Coke spread, my, just so you know, convention I'll use throughout the semester, I'll do a company. You can see a bunch of screenshots, KO, and then the screen, RV, just so that you can replicate what I do. Okay? But you will have to take a screenshot similar to this and then save it and then upload it, put it on a thumb drive, whatever. You don't have to use the Windows screenshots. What's important is that when you do take the screenshot, across the bottom will be a serial number and your account number. It's unique. Every screenshot is unique. You're not allowed to use other people's screenshots. If we find that you submit somebody else's screenshot, it'll be considered an honor code violation, right? So I don't like honor code violations. So I'm being very clear. The only way in this class you're going to be successful is if you use Bloomberg yourself. You have to do these assignments yourself. You have to use the tool to do it. This is a class that involves Bloomberg. So in your homework assignment, hint, hint, you're going to have to do a screenshot. You're going to have to probably talk about industry attractiveness. and the homework assignment's going to be available 5 p.m. today. You'll need Bloomberg. It'll be due Monday, 10 a.m. See everybody on Monday. Have a good weekend.
Thank you.